All right, we are looking at the BigLights Limited case study here. Let's scroll down and read that first question. And just to throw this out there in the beginning, this case is quite difficult. So if you're having trouble with it, don't let that discourage you. Work through it a couple times and do the best you can, but I will say it's very difficult. Question 1. Using 2017 data, suppose the company wished to pay off all of its debt while maintaining its current reinvestment policy. How many years would it take to do this? All right, let's scroll up and read until we get to that first exhibit where we'll have information we need there. Mark Wobble is the chief financial analyst at Maryland Woods. He was asked by Ruchi Kapoor, the firm's chief investment analyst, to analyze the common stock of BigLights Limited, a company that observes IFRS while preparing its financial statements. BigLights Limited is a major producer of renewable energy utilities like solar panels, windmills, and handheld solar lanterns. It has three major operating segments: home lighting products, industrial products, and street lighting units. Selected financial data for the company is presented in Exhibits 1 and 2. All right, so we've got Exhibit 1 here. So we basically need to figure out, looking back at the question, so we need to look at how many years would it take to pay off all of its debt while maintaining current reinvestment policy. So what we're going to be looking at here is we need to know the level of debt, and then we need to know the current reinvestment. So this is usually going to be in some form of CapEx or related to R&D or something like that, where we're putting money back into the business. And so then taking that away from kind of the cash flow that we get. So we'll take our cash flow, take out reinvestment, and then we can put all of that remaining towards debt. And so once we kind of have those numbers, we can see how long it would take. So we've got Exhibit 1 here. So we've got operating cash flow. So I think we'll be using this number here. And we've got operating income, sales, interest expense, operating lease payments, cash interest paid, cash taxes paid, total assets, capital expenditures. Okay, so we'll be using that as our reinvestment. And then expenditures on intangible assets. This is also going to be a reinvestment. So capital expenditures and expenditures on intangible assets. The main difference here is CapEx is going to be on physical assets, whereas intangibles are not physical assets, but something like intellectual property. And then we've got our debts here. So we've got current long-term debt or current debt and long-term debt. So what we need to do is assume we have this cash flow. We're going to take out these capital expenditures and then basically compare this to the current debts, or both of these all of our debts, and then understand how long it would take to pay off those debts. So let's pull those numbers in right here. So we're going to take total debt over operating cash flow minus reinvestment. Total debt is going to be these two numbers here. Just add them up. Reinvestment will be those two numbers that we highlighted added up. And then we're going to subtract that out of the operating cash flow, 2694. So if we put all of our operating cash flow minus reinvestment towards this almost 4,000, and this is in millions, but 4,000 in debt, it would take us 2.33 years. And we'll round that and go with answer B. All right, we're looking at question 2 now. Based on the lease information in Exhibits 1 and 2, the company's adjusted long-term debt to assets ratio as of end of December 2017 is closest to. So we've got 0.1116, 0.1, or 0.125. So we already read up to Exhibit 1, and we're going to be using the long-term debt to assets ratio. And so basically the information we need here that we haven't gotten so far is to find out this lease information, because what we're going to end up doing is, let me scroll up here to Exhibit 1. We're going to take this long-term debt ratio, and then we have our assets of 22107. Essentially, we need to kind of adjust this for the leases that we currently have. And the way we're going to do that is we're going to take the present value of those operating leases and that's basically using a annuity in advance. So we're going to be using this formula right here, where A will be the lease value, V is going to be discount factor, N will be number of periods, and then D is going to be the discount rate. So V is discount factor and D is discount rate. So there's a lot of different variables at play here, but we'll walk through each of them step by step. So we're going to need to calculate, again, we're going to need to calculate the present value of any operating lease agreements, and then we're going to add that to the assets and the long-term debt. And the assets over debt, or the debt over assets formula is pretty simple. It's just going to be this number plus whatever we get, divided by this number plus whatever we get there. So we read through Exhibit 1. Let's read Exhibit 2, which is the notes from the financial statements. Let's read until we get to any lease information. All right. Revenue recognition. Revenue from the sale of goods is recognized in the income statement at the moment when the significant risks and rewards of the ownership of the goods have been transferred to the buyer, which is mainly upon shipment. In special circumstances, at the customer's request, the company may sell products on a bill and hold basis, provided that the product is ready for shipment. Such goods are segregated and the risks of ownership and legal title have passed to the customer. This practice is limited only to customers who are government agencies who request it for budgetary and physical planning reasons. The amount of such bill and hold sales averages about 3% of consolidated sales annually. Okay, so nothing there. We got PP&E. Up until 31st of December 2017, the company amortized its machinery and equipment on a straight line basis over an 8-year expected useful life. As of 2018, the company's estimate of the useful life of certain machinery and equipment will be reduced to 8 years. Again, nothing there. Let's keep going. Restructuring changes. In 2017, the company introduced an early retirement program. Under the new program, employees who were 55 or older would be allowed to retire voluntarily. As it turned out, a larger number of employees than anticipated accepted the offer. The company recorded an expense of $11.55 million, of which $5 million was classified as non-recurring. All right, then here we go. Leases, financial and operating leases. So we've got the implicit interest rate on finance leases for 2016 and 2017 is 7%. So that's important. This is what we're going to use as our discount factor in that formula up here. So that's going to be our D, 7%, or our discount rate, not discount factor. And then we've got operating lease commitments are as follows. So due the January 28, 29, 20, and 21, we've got $195 million. And then due January 2022, we've got $120 million. Total of future lease payments thereafter, 480. Total commitments 1380. So after 2022, all lease payments are assumed to be the same as in 2015. Wobble has reasons to believe that the recent increase in profitability is the result of earnings management. In defense of this belief, he presents the following information to Kapoor. Okay, so we've got to everything we need. We have our lease amounts here, and then we have our long-term debt and total assets up here. So basically, we have two annuities. So this first one is starting in 2018. So we have 1, 2, 3, 4 payments. So this is going to be a 4-year annuity, where we have $195 a year, and then after that we have $120. And then from the total future lease payments thereafter, we have $480. So we can kind of deduce there that we have 4 more payments of $120. So we have a 5-year annuity and then a 4-year annuity. And so we need to get everything back to the present value of 2018. So what we're going to do here is these cash flows of $195, we're going to discount this back to 2018, so 4 years. The 120 is a little more difficult because we're going to have to discount that back to 2022 and then again back to 2018. So there's going to be 2 discounts there. And then I guess with our formula, N is going to be 4 for the first one, for the first annuity, and then 5 for the second annuity. So I've got all this information down at the bottom, so I'm going to scroll all the way down and we can walk through all these numbers. All right, so I've got the formula here again. So we have A, and then 1 minus Vn over D. And then I also have the formula for calculating V and D. Okay, so the formula for calculating that discount factor is going to be 1 over 1 plus the interest rate. So that interest rate is 0.07. So we've got 1 divided by 1.07. So we've got 0.9346. And then D, our discount rate, is going to be the interest rate divided by 1 plus the interest rate. So that 0.07 over divided by 1.07, 0.0654. And we're using the 7% number for that I variable. So then from here, that annuity starting in 2018, so we're going to have 195 times the discount factor. So this is where we're using the annuity in advance formula. So we've got 195 as our A variable, 0.9346 is the V, 4 for N, and then we're dividing that by our D, our discount rate. So when we do that, we get a 706 and some change. And then for our annuity starting in 2022, it's going to be that same thing. So we get 526.47 in the end. However, like we said up above, this is bringing us back to 2022. So then we need to discount this back even further, back to 2018. So for that, we're going to be using that straight up interest rate there. And we're going to divide that by 1.07 to the fourth, bring that back to 2018. So we get 401 and some change. So our total present value is going to be 706, number we got up here, plus 401, brings us to a little over 1100. A lot here. So then for the last thing, we're going to be taking that debt number, 1482. And let me just scroll up one more time to show you where that was. That was in Exhibit 1. So we've got 1482 and then 22,000 as the asset number. So we basically just add the 1108 lease number to the numerator and the denominator. Gives us 0.1116. Answer A. I think I said this at the beginning of the last question, but this is a very difficult question, and you probably wouldn't get something this in-depth and this many variables in play on the actual exam, but this is still a really, really good exercise to go through and understand all the nuances and moving parts here. So there you have it. All right, we've got question 3 now. The interest coverage ratio for 2016 after capitalizing the operating leases is closest to. So we've got 15.5, 14.3, or 13.7. So the interest coverage ratio after capitalizing these operating leases, so basically we're going to be making adjustments to the data that were already given before. So this new interest coverage ratio ends up being revised EBIT divided by the revised interest expense. So EBIT over interest expense would be the interest coverage ratio, but since we're making that adjustment, we'll just call it the revised EBIT. And so a couple of the nuances here. So if we're capitalizing operating leases, basically the adjustments we're going to need to make to EBIT are excluding lease payments, but we're going to include depreciation expense on the capitalized leases. And then the interest expense would include interest on the capitalized lease debt. So we need to apply these debt adjustments to EBIT and into the interest expense. So let's scroll up until we get some more information here, since I don't think we have quite enough yet. So we read through here. Well, we'll read this part again. Wobble has reasons to believe that the recent increase in profitability is the result of earnings management. In defense of his belief, he presents the following information to Kapoor. So we've got Exhibit 3, which is selected accrual cash flow and profit ratios as of 31 December for BigLights Limited. So we've got cash flows, accrual ratio, balance sheet accruals, operating cash flow over operating income. revenue, revenue to cash collector ratio, net profit margin. So let's keep reading. In response, Kapoor says, the comparison you have made between operating cash flow and operating earnings is biased upward when comparing to accrual-based operating income. Wobble says, although the company could repay all of its debt and maintain its reinvestment if it chose to do so, there are off-balance sheet issues to consider. I'm in the process of capitalizing the operating leases, okay, but so far have only calculated the adjusted long-term debt ratio, debt to equity ratio for 2016. It is shown in Exhibit 4. So we've got the long-term debt to equity ratios, and then we have for 2016 unadjusted, and then after capitalization of capital leases, we have 25%. So this is going to be something we'll use for our debt adjustment for the calculation. Wobble has doubts. Okay, so I think we have what we need. We have this number here, which is important, and then we've had a lot of information on the leases and other financial related stuff up here as well. So let's scroll down and we'll start talking through the answer, and then I'll go back up to kind of reference where that data was pulled from. All right, so we'll start with the debt adjustment. So the debt adjustment, we'll take adjusted amount of debt is 0.25 equals the adjusted debt over 10,619. So we get adjusted debt of 2,655. And then our capitalized operating lease is going to be the adjusted long-term debt minus the original long-term debt. So we get 2,655 minus 1,775 equals 880. And so that 1,775 number, that's coming from up here. We're using 2016 data for this formula. And the shareholders' equity, the 10,619, that's where this was pulled from. So we're using the long-term debt to equity for the capitalized by capitalizing leases. Sorry, I might be losing you here. We're given this formula, long-term debt to equity, which is what this is right here, adjusted debt over equity. So we don't have the debt number, but we have the ratio and we have the equity number, so we can calculate the adjusted debt based on that. So from there, by taking the adjusted amount minus the original amount, we can then impute what the capitalized operating lease amount is, which is 880. So then to revise EBIT, I think we mentioned this earlier, so we're going to take our operating lease payments of 124, and then we're going to take the estimated depreciation on newly recognized assets. So we got 880 from here, and then in the notes, we had that we were going to be using 8-year expected useful life. So that depreciation should be 110 per year. So that's where we get that. Make those two adjustments to get the revised EBIT number. So now we have to calculate the interest expense and coverage. So we have interest of 157, which was taken from right here. And then the next part is this 7% interest rate is assumed, and we're using that 7% to calculate our new adjusted interest expense. So that's also going to be on that 880 number times the 7% gives us 61.26. Adjusted expense ratio then is these two numbers added together, 218. So then we can just plug these two numbers that we calculated into the formula. Gives us an adjusted coverage ratio of just under 14, which is answer C. Question 4. Based on Exhibit 3, which of the following statements is most appropriate? A, the company experienced less cash earnings than accounting earnings in 2017. B, Kapoor's comment about the bias in the cash flow to operating income ratio is correct. Or C, the company's earnings quality has improved in 2016 according to the cash flow based. So we already read down to here, but let's scroll up and we'll look at Exhibit 3. And we need to also read Kapoor's comment, which is right below here. So we're looking at the earnings quality, and we're kind of deriving that from the accrual ratios. So in Exhibit 3, we've got the cash flow accruals ratio, which is 10.5%. in 2017 and minus 12% in 2016. So a positive balance indicates that cash earnings are less than accounting earnings, and a negative balance indicates that accounting earnings were less than cash earnings. So positive balance, cash earnings less than accounting earnings. And how that happens is basically you have more accounts receivable, which is basically an IOU, than you did in actual cash revenue that came in. And we have balance sheet accruals ratio, operating cash flow to operating income, revenue to cash collected ratio, and net profit margin. Okay, so then in response, Kapoor says the comparison you have made between operating cash flow and operating earnings is biased upward when comparing to accrual-based operating income. So this is for answer B right here. So the comment, Kapoor's comment about the bias in the cash flow to operating income ratio is correct. So this is going to be false because accrual-based is typically going to upwardly bias earnings relative to cash flow. Because kind of what I mentioned up here, if we have more and more accounts receivable, those are essentially IOUs, and there's no guarantee that we'll get paid there. So that makes the earnings look greater than the cash flow would be. So it upwardly biases. Sorry, but he has it backwards. So it's upwardly biased from accrual-based would upwardly bias relative to operating cash flow and operating earnings. So we can cross off B. And so then let's look at A and C. So A, the company experienced less cash earnings than accounting earnings in 2017. That's going to be correct. Since, as we mentioned for these top two numbers, so negative or a positive number here indicates that cash is less than accounting. So in 2017, we had less cash earnings than accounting earnings. And in 2016, we have a negative number, so that was flipped. So we did experience less cash earnings, so that would be, looks like it'll be our correct answer. Let's just make sure we can also rule out C. So C, the company's earnings quality has improved in 2016 according to cash flow based. So our earnings quality has decreased. To have higher quality, we want to have more cash flow, less accruals. But as we've kind of gotten through on the other two answers, we're earning less cash and more accounting income, which is more accruals. So our earnings are lower quality. So all that said, we'll stick with A.